Gold currency wars. Year-to-date, gold is down about 10% in US dollars. Relative to the US equity markets, which are down closer to over 21% as of this writing, gold is actually outperforming, or the lesser loser. I often hear, Marin, why are you hating on gold right now? First off, I don't hate gold. I've stated for many months that gold equities and the gold spot price will be under pressure in US dollar terms. Many investors are oblivious to what data is screaming right in front of them, and we'll cover those today. I own large positions in a few gold stocks, and that's for the long term. I'll also be taking some tax losses on the ones that didn't pan out as expected. But short term, all the signs are pointing to tough times ahead for gold stocks. The prudent alligator investor must take caution, build up a cash war chest, and prepare for a max exodus. Hopium is still in full force, whether it's gold, silver, oil, Bitcoin, or whatever. Going all in is never a good strategy for cyclical high-risk stocks. It's a recipe for disaster, and one that can be avoided if you follow some first principles like the Katusa tranche system. Click the link here if you need an update on that. Gold's technicals don't look good right now. The chart below shows some rough technical goalposts for gold. You can clearly see the double top occurring in early 2022 and acceleration to the downside over the last 9 months. Prior to the breakout in 2019, gold spent 6 years in consolidation between $1,200 and $1,400 per ounce before it broke out. Short-term momentum is clearly in favor of the bears, though any pivot in policy could snap prices higher overnight. And don't forget the FX. Gold in almost all currencies except the US dollar has done its job, protecting from fiat devaluation. It is a very challenging time to be a gold investor, as there are a lot of whipsaw action coming from both camps. Currency wars and gold protection. If you're a gold investor outside of the US who has purchased gold in your local currency, you have likely done quite well. This is something we have talked about for years. The reason is in the strength in the US dollar or weakening in the foreign local currency increases the gold price per ounce in that local fiat currency. Look at the chart right now, the performance of gold of currencies around the world, like the yen, euro, pound, dollar, and the won. Money flows from low capital return regions to high capital return regions. This suggests that as US interest rates rise, demand for the US dollar will increase and reduce the gold price in US dollar terms. Now staple this to your desk. For gold to truly be in a bull market, it must rise to new highs in all currencies, including the US dollar. Now let's look at the gold COT, the commitment of traders. Every week, the agency that oversees the US futures market, the CFTC, releases a report that shows how companies and hedge funds are positioned in the futures market. This report is called the COT. Various participants with various goals come together in the futures market. Managed money has tended to be a contrarian indicator for gold. Gold has staged powerful rallies as managed money positions have built up large short positions. That's the circle chart you're looking at right now. And look at the red parts. That's the managed net positions, or short. The complicated gold relationship. We've talked about this before. The relationship between real bond yields and the gold price is a classic negative relationship. A real bond yield is a bond which is adjusted by the equivalent maturity break-even interest rate, meaning if you take the 10-year yield and subtract the 10-year rate earned on the 10-year Treasury inflated protected security, the TIPS, you're left with a real rate of return which is adjusted for inflation. The chart you're looking at next shows the relationship between the real yields and gold. Each dot on this chart represents the gold price and the real yield on the US 10-year bond each week since 2006. That yellow line going from top left to bottom right shows the trend of the data, which you can see plainly with your eyes. As real yields increase, the gold price declines. Now the current real yield is at 1.38%. Now the correlation here is not perfect, but it's pretty strong. We relied on this chart heavily during the era of negative yields to help estimate the direction of the gold price. We can use it again here when real yields are positive also. Now, do I think this model is perfectly accurate? No, not a chance. But I do believe it forecasts the price trend of gold well. Thus, if real rates stay elevated or increase, which is expected in the near term, this will be negative for gold priced in US dollars. Now, Katusa's portfolio positioning. I recognize I have painted a lot of negative views here, but I am being totally transparent and honest with my feelings and expectations for the market in the near term. Now, things can change and you have to change your view. We may get occasional bear market rallies, and the plan should be to sell any market strength, but gravity will continue to take hold. That means sellers will outweigh buyers. Interest rates are going to continue to rise in the near term in most nations, which directly increases the cost of capital for businesses and slows economic growth. I've been writing about this for almost a year. Recall, this is not just my outlook, but it's the outlook of the United States Federal Reserve Chairman. He calls the shots, and we play them the best we can. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.